We're going to review the effective interest rate method by looking at a note receivable for $10,000. We have a note receivable with a period of 3 years. It's going to pay out $10,000 at the end of 3 years. Each year, though, it will pay us $1,000 of interest, which is based on 10%, a 10% rate, which is 10% of the $10,000. At that time, at the issuance of that note, the market rate is determined to be 12%. This rate is the yield on that particular note, and it's going to fluctuate over the life of that note. So if we sold it, that market rate would be different at that date of sale. If you review the first entry, we're going to record a receivable for $10,000, which is the amount that we expect at the end of 3 years, and we're going to credit cash for 9519, which represents the amount of cash that we're going to loan out based on the 12% market rate. That's shown in the first line of this table. The carrying value of that note at the date of issuance is determined through a present value calculation. The rate is based on the market, so the 12% is what we're going to discount that note over. The period is 3 years, the payment is the $1,000, and the future value is the $10,000. So the carrying value is calculated as 9519. Each line represents a year of that note, and in the first column we've got our cash payment, which we already determined to be $1,000. The interest revenue fluctuates, and it's calculated by taking the market rate of 12% multiplied by the beginning carrying value. So this is basically the C6 cell, which is 12%, multiplied by E9, the beginning carrying value. This column represents the difference between the interest revenue and the cash, which is the discount amortization. We take that discount amortization and we add it to the preceding carrying value because we're trying to arrive at $10,000. So we repeat that process for the next 2 periods. Each of these lines represents one journal entry. So in year 1, we would have a debit to cash for the $1,000. We would credit interest revenue for the $1142, and we would debit discount for $142.36. We repeat that same entry with different quantities for the next 2 periods. At the end, we receive the cash of $10,000 and we write off our note. So what we're doing in these entries is to record the cash payment and also to record the fact that this discount of $480 is being amortized over the life of that note, and it's turned into interest revenue gradually over the life of that note. So we don't record interest revenue all up front for $480, but we do record it gradually over the life of that note. You can see that the interest revenue is not $1,000, the actual cash that received, but it's reflective of both the $1,000 and a portion of that $480 gradually over the life of that note. Finally, at the end, the discount is completely amortized off of our books, and we just have to debit cash for the $10,000 payment that we receive, and we credit off the note receivable.